Should you refinance or not refinance? That is a question that I've been getting by a lot of my clients, and so I thought I would make a video to talk about the benefits of refinancing, why you need to refinance, and whether you should or should not refinance. So let's get started. Hi, my name is Joe Eslait. I am a real estate broker for Casa Real Estate. Welcome back to my channel. If you're new to my channel, please consider subscribing as I post videos on all things real estate here in Rochester, Minnesota. So benefit number one is when you refinance, hopefully you're getting a lower interest rate. So that means that your monthly payment should go down. If you haven't heard or seen, interest rates are currently super low. And so right now you can get a loan for a 30-year mortgage under 3%, which is amazing. Another benefit of refinancing is you get to get rid of the private mortgage insurance. If you want to know more about private mortgage insurance, feel free to check out my video that I made on what private mortgage insurance is. Another benefit of refinancing is that by lowering the interest rate and getting rid of private mortgage insurance, if you currently have that, is that your monthly payment is going to go down pretty significantly. And the last two benefits of refinancing is that you can pay off your mortgage faster by reducing the amount of time that you're making payments, either from a 30-year loan to a 20-year loan or even 15-year loan. And then lastly, that you can go from having a adjustable rate mortgage or an interest rate that fluctuates. So you can go from having that kind of loan to a fixed rate loan where the interest rate is going to be the same for the term of the loan. So these are 5 benefits of refinancing. Now let's talk about what you need to have to be able to refinance. So number one, just like when you bought a house, you need to have income, you need to have a good credit score, and you need to be able to get a mortgage from a bank. And then the second thing that you need, which I think is the most important, is you need to have an 80% loan to value. 80% loan to value means that you have 20% of equity or value in the property. So how do you achieve this? Well, you can do it one or two ways or using both ways. So number one, your house has appreciated during the time you've owned the house for you to have 20% of value, and or you've paid down your original your current mortgage, you've paid it down 20% or maybe less of what the house is currently worth, or by combining what the house has appreciated with what you have paid off in the mortgage, then if you need to have 20% in value either way, or with those two options combined. Now, before you get very excited, a couple things to consider before refinancing or talking to a lender, or while you're talking to a lender, are how long are you planning to live in the house? Refinancing, just like when you buy a house, is going to have certain closing costs or fees associated with it. So if you're not planning on being in the house for too long, then maybe refinancing is not a good option. But if you're planning on staying in the house for the foreseeable future, then refinancing could be a great option. Another thing to look at is how much are you going to save every month, and then finally what the cost associated with refinancing is. Now I want to share my computer screen and just look at some examples to compare what refinancing could look like with different scenarios. All right, so here we are. So this is an Excel spreadsheet where I have your current mortgage table here. And then if you go down, I have a new mortgage table. So let's start with the current mortgage. So let's say you bought a house for $200,000. You did $6,000 for down payment, or 3%. Your loan amount was, when you bought the house, 194,000. Your interest rate 4.5, 30 years. This is what your payment and interest rate would be, 982. And then let's say you're paying private mortgage insurance or PMI of $100. Since you didn't do 20% down payment, you did 3%, you're going to have some sort of PMI. If let's assume your property taxes for the whole year is $2,500 and your insurance is $1,200 a year, so $100, right? So your monthly house payment is $1,391. When you refinance, the two things that you can control or change are your payment and interest and your PMI. Property taxes and insurance is gonna those are independent from refinancing. So let's focus on the payment and interest. Now, for your new mortgage, let's say that you do qualify for refinancing and you're just trying to see what the benefits or how much you would save and that kind of information. So your refinance amount, let's say you've lived in the house for a couple years and you've been able to pay off 4,000 in principal. If you remember, we started at 194, so you've paid in principal, let's say 4,000, so you're at 190. That's why you want to refinance. Okay, so your loan amount would be so down payment. You wouldn't put anything else. We're assuming that you have 20% of equity or value in this house, and so you refinance at 190. The interest rate is now 3% instead of 4.5, and the term of the years, let's just do 30 years. Your new payment would be $801. We get rid of the PMI. Your property tax and insurance, we'll just keep those constant. So your new payment would be $1,109. If we go here to the right, the interest difference is 1.5%, and your monthly savings between principal and interest and PMI would be $282. So that would be a big decrease. So that would be awesome. Now let's assume that your closing costs are $5,000, and this is gonna vary between lenders, but it probably not vary not too much. I'm just picking 5,000. It could be more, it could be less. So let's pick 5,000. If you divide 5,000 by the 282, the savings, your monthly savings, that means that you're gonna have 17 months before the closing costs, investment or fees that you're paying start to actually you start actually profiting from that. So after 17 months, then every $282 savings per month, you'll start like benefiting from that, right? Or another way to see it is about 1.5 years. So that would be a huge benefit, and the break even point is not bad, a year and a half. So if you're planning on staying in the house for the next 5 years, right, you know that you're gonna have several years where it's paying off to refinance. Now, if you're thinking about staying in the property for another 2 years or less than a year, then obviously wouldn't make sense to really refinance because you have that closing cost expense. Now, another thing I want to point out in this example, let's say, so you bought the house for $200,000, and you've paid down, you did 6,000 for down payment, so you owe 194, and at the time of refinance, you've paid down another 4,000 in principal. So at 190, for if you have a balance of 190, the value of the house, or the house, has to appraise to $240,000 for you to have 20% in equity, if that makes sense. So if you do 20% of 240, that should give you 190,000. Hope this makes sense. If you have questions, feel free to write a comment below and ask questions that you have. Or if you've had some really good interest rates that you've been able to benefit from, feel free to share. Or if I miss anything or there's anything you would like to add, feel free to comment below as well. I hope you found this video helpful. If you did, please like and feel free to subscribe. I'm going to continue posting some great videos here to help you with all your real estate needs.